Hello friends, welcome back to Accounts Made Easy, and let's continue with our chapter Consignment. In this video, we are going to learn about different types of losses. There are different types of losses in consignment that we need to understand. After that, we will be having a look at the concept of loading, and then the last part, which would be valuation of unsold stock and abnormal loss. So these are the three main topics that we are going to cover in this video. Let's start with the first part, which is called types of losses. As you can see here, that whenever there is a loss, I repeat, the term loss here does not mean the revenue loss, which means it is not the same as income minus expense and loss. Here, when we use the word loss, we are talking about the loss of units which are consigned. Okay, like for example, I consigned 1,000 units to my consignee. However, due to some reasons, 10 units of my goods were lost. This loss is what we are talking about. So let's not get confused with the term loss. Okay. So whenever we say that there is a loss in consignment, the first and the foremost thing that should hit our mind is whether it's a normal loss or is it an abnormal loss. Now, sir, what is a normal loss? What is abnormal loss? So let's have a look at both of them and understand them very carefully. These are the differences, or you can say important points to help us decide whether that's a normal or an abnormal loss. If you look at the normal loss, it is an expected loss. If a loss is expected, obviously it is unavoidable. Now, because the consignor is aware about this kind of a loss even before he starts consigning goods, obviously he does not record such a loss in his books of accounts. The reason why he does not record this is that the value of such loss is always zero. Okay, the value of normal loss is always zero. Alright, now because certain units are lost, however, our total cost remains the same. Therefore, a normal loss increases our cost per unit. Likewise, if we try to have a look at an abnormal loss, you will realize that it is exactly the opposite of normal loss. Let's look at the first point. Normal loss says expected. Abnormal is obviously unexpected. Suddenly a loss comes in. The next one is, if a normal loss is unavoidable, abnormal loss is always avoidable. If a normal loss is not recorded, abnormal loss is recorded in the books of accounts. If I say that the value of normal loss is always zero, abnormal loss will have a value. We will have to calculate that. In fact, that's the last thing that we are going to do in today's class. Okay, and yes, normal loss will increase the per unit cost. As far as abnormal loss is concerned, it does not affect our per unit cost. Okay, to understand this, let's take a simple example. If I am dealing in cement, okay, I'm sure you all know what a cement is, right? You know that big bags of cement are transported from one place to another place. If you have ever seen anyone unloading cement bags, every time they throw a cement bag from a truck on the road, there is a certain quantity of cement which is lost. That's expected, that's unavoidable. You cannot do anything with that. Okay, you cannot expect laborers to put it down like a feather. That does not happen. Such a loss will occur. So that's a normal loss. Abnormal loss. When the labor is unloading that cement from the truck, they did not notice that there is a water on the road and they put the bag on the road. The cement is gone. That's lost. That's an avoidable one. Okay, it's a man-made loss, and such losses are abnormal losses. Abnormal losses are to be valued, not the normal losses. Now, sometimes what happens is in exam, they would not be giving us any such information. Then what happens? Understand one thing very carefully. If certain loss which is an expected or an unavoidable loss, such a loss cannot be insured. However, any unexpected or avoidable loss is always an insurable loss, which means if they say that goods are destroyed and we received insurance claim, you will receive insurance claim only on abnormal loss. Normal loss is an uninsurable concept. I hope we have all understood this. Alright, types of losses. quite important from problem point of view. A lot of problems we come across where we are going to see such kinds of losses. All right, so now let's move to the next part, which is called loading. Okay, again, clarification. Meaning of the term loading with reference to consignment is a little different from the normal term loading in English. Normally in English, to load is to put something up. Here it's not that. Here the term loading basically means increase in the cost price to hide the actual value of goods from the consignee. See, consignor would never want consignee to know what is his actual profit. So what he will do is, if he has a goods costing rupees 100, he would add 10 rupees to it and send a pro forma invoice to the consignee showing the price at 110. Now the difference between this invoice price and the cost price is what we call as loading. Alright, so loading is an excess amount shown by the consignor in pro forma invoice to avoid the consignee to know the actual cost of consignment. Loading is something which is extremely common in a real life situation. Alright, now loading. In exam, normally loading will be given as a percentage. You need to remember one thing. They can give us loading as a percentage of either cost price or as a percentage of invoice price. It can be given as a percentage of either of this. Now, how do we convert it? If they have given you percentage of cost price, but they have given you the value of invoice price, how are we going to convert that? For that, there are two approaches. Okay, let's have a look at the first approach. This is called a ready-made conversion table. Okay, if loading is given to us as a percentage on cost price, okay, this is the percentage on cost price. This becomes the value or the percentage on invoice price. You can also do it the other way around. The table is basically showing the movement from this to this, but you can also have the movement from this to this in exam depending on the situation. Which means if I'm saying it's 20% on cost price, it will become 16 2/3% on invoice. It can even be vice versa. Like if it is 20% on invoice, it can be called as 25% on cost. Guys, sometimes remembering percentages might be a little bit challenging job. So what we do is we have converted that into fractions and that becomes easy. 20%, I hope we all understand, it is 1/5. If I add 5 plus 1, I get 1/6. To the denominator, you add 1, you get the loading on invoice price. Okay, for example, if I say loading is 33 1/3, which means it will be 1/3 on cost price. 3 plus 1 is exactly 4. So it becomes 1/4 on invoice price. If you are moving from invoice to cost, minus 1 from the denominator. Okay, this is one way. There is another way of doing it, which let's understand it with the help of the sheet. Okay, right now, if you look at this particular way, I'll show you something here, how we can do that. Let's say I have a cost price. Okay, now this cost price, we are going to add loading to it. To this cost price, we will be adding loading. And then what we get is invoice price. Now, what we have to understand here is that loading can be given as a percentage on cost price, or it may be given as a percentage on invoice price. Guys, one simple rule. After on, what do we have? Do we have cost price or do we have invoice price? Like in this example, if you look at this, what we have is a cost price, but in this example, if you look at this, what we have is an invoice price. If loading is given as a percentage on cost price, you will take cost as 100. If loading is given as a percentage on invoice, you will take invoice as 100. This is something that you people need to remember, guys. Pay attention to this thing very carefully. Let's take an example from the earlier slide. Let's say it is 25% on cost. So I have taken cost as 100. To this, I add 25% of loading. So I get my invoice price as 125. The job's done. Which means my loading is either 1 by 4 of cost or 1 by 5 of invoice. But now 25% of cost is actually equal to 20% on invoice. If they say it is 20% on invoice, what I do? I will take my loading as 20. But understand very carefully. Here what we have is we are adding it. We are adding loading. And now what we are required to do is we are doing a reverse calculation. We are going up from bottom. So 100 minus 20, 80. Guys, look at them carefully. There is no difference. 25 by 100 is 1 by 4. 20 by 80 is also 1 by 4. So this is exactly same. Now this is what I call intelligent people's approach to calculating loading. Rather than by hearting, see, you can by heart this table. There is nothing wrong in it. But in exam, we can make a mistake. Rather, we can just pay attention to this, understand this by common sense, and things will become easy for us. So to understand this, what I have done is I have taken up a few examples. Let's discuss them. Let's read the first question, what it says. It says cost of goods is 100. So, okay, we have our CP as 30,000. And then we have loading, which is 20%. Okay, we have got both of them. Now what we have to do actually is try to understand or calculate our invoice price. What we need to do is we need to calculate our invoice price. We don't know what it is. Simple. Let's use the formula that we have written here. Let's use this formula. Let me just copy this down and let me bring it here. Okay, my cost price is there, but loading is what? 20% on cost. So I will take cost 100. My loading will become 20. All right, and if you add both of them, what you get is my invoice will become 120. Understand this carefully, because here if you look at this, after on the word given is on cost. So I've taken my cost as 100. Okay, important for us to understand. I added loading, I got this. Now look at this question. I have got a rupee value of cost. So I write here 30,000. My job's done. All you need to do is what you people have done earlier is what you have to do now. Cross multiplication. So here what you will get is 30,000 multiplied by 20, which is then to be divided by 100. And if you do this calculation, you get the answer as 6,000. So your invoice will become 36,000. And guys, the job's done. Look at this carefully. Simple calculation. Here what I have done is I have simply done cross multiplication, what we have been doing for such a long time. This is a simple cross multiplication. 30,000 into 20 divided by 100, and we got our value of loading. Right. So when you add cost plus loading, you get the answer as 36,000. The job's done. Understand this calculation carefully. Okay. Now I'll just remove this. Let's look at the next question here, which is next example in fact. Which says cost of goods is still 30. Very good. We again have this 30,000. But now the problem is that they are saying loading is 20% on invoice price. So I take my invoice as 100. This is 20, and what I get here is 80. No problem. Again cross multiply. Here the calculation will be 30,000 multiplied by 20 divided by 80. If you do the calculations, you get 7,500. If you want, let's do this calculation. This is to be multiplied by this and then divided by 80. So we get 7,500. Our invoice price will be 37,500. So guys, look at both these questions. In both questions, you will find that yes, cost of goods sold is 30. In both questions, you will find that loading is 20. But invoice price, in one I am getting 36, in one I am getting 37. Magic. No magic. What is marked in red is important for us to understand. Alright, so these are the couple of questions which I wanted to discuss with you people to make you understand loading. Guys, look at the screen carefully, understand this carefully. Quite important from examination point of view. Okay, now let's proceed. So with this, we are through with our loading part, and now let's go back to our basic, and what we will do is let's have a look at the last part of theory in this chapter, which is valuation of unsold stock and abnormal loss. Normally people take them as two separate terms. Yes, absolutely correct. Unsold stock, abnormal loss, they are not the same. They are completely different. However, what happens is the method to calculate them is same. Before we go for the method, let's understand. The term unsold stock means, see, consignor has sent certain quantity of goods to consignee. Not necessary that consignee has sold all the goods. Some goods are still lying unsold with him. That's called unsold stock. It is also commonly known as consignment stock. Okay, unsold stock is also commonly known as consignment stock. What is abnormal loss? That we have understood. One thing that you need to understand here is this unsold stock would normally be in consignee's warehouse, wherein if you talk about abnormal loss can occur at two places. One, it can occur in transit. That means goods have started moving from consignor's place, but they have not reached consignee. They are on the way. That's called in transit. Or the loss may occur even after reaching consignee's warehouse. Okay. So based on that, the formula is absolutely same. In fact, you will find that everywhere unsold or abnormal two terms are used. All right. Now let's look at this. It says cost of unsold stock or abnormal loss. To that, what we add is proportionate expenses of consignor. Understand, every expense incurred by consignor is non-recurring. So all the consignor expenses you have to add. All right, but proportionate, not the full value. What is proportionate? We will understand that. Okay. Now, the value of goods lost in transit. If goods are lost in transit, please keep one thing in mind. They are lost in transit. Consignee never received them. If consignee has not received them, that means he is not incurred expenses for those goods. All right. To this, we will add. Now, this is what you people need to remember and understand. Only the non-recurring proportionate expenses of consignee. Non-recurring, also commonly called as non-selling. Non-recurring are also commonly known as non-selling. Now, sir, how do we understand? Simple. Any expenses incurred by consignee up to the time goods reach his warehouse are non-recurring in nature. Once the goods have reached his warehouse, any expense incurred after that is recurring in nature. All right. So you need to again add only the proportionate part of the expense and you get the value of unsold stock or abnormal loss. Guys, this formula, it looks so big. If it's an individual short question, you have to write the whole formula and solve it. If this is a part of a long question, which is always there, every good long question will have calculation of unsold stock minimum. Sometimes there might also be abnormal loss. Then that calculation will be done as a part of working note, which is very simple. All right. Now, there is a note that you need to understand. Any expense incurred by consignee before goods reach his warehouse, that is what I just told, are called non-recurring expenses. That's okay. The second point is more important. In absence of information, consignee expenses are always considered as recurring expenses. In absence of information, consignee expenses are always considered as recurring expenses. Ignore them for the purpose of calculation of unsold stock and abnormal loss, right? So guys, this is about the total theory that we need to understand before we proceed to the numericals of this particular chapter. All right. So I hope you people have all understood this and we are very clear with this concept. So let's wait for the next video when we start with the numericals. Till then, thank you guys and take care. Bye bye.